Married couples are leaving $7,000 per year in tax-deferred growth untouched, and the IRS practically begs you to claim it. This is Tax Shield Research Team. Today we're breaking down spousal IRA contributions under IRC Section 408C, provision so overlooked that data indicates roughly 60% of eligible households never maximize it. That's not an accident. It's a blind spot we're about to illuminate. Let's start with the math that should alarm you. Research shows the average married couple with one non-working spouse or a significantly lower-earning spouse misses out on $7,000 in annual IRA contributions. That's the 2024 contribution limit per person. But here's where it gets painful. Multiply $7,000 by 30 years of working life. Factor in a conservative 7% average annual return, the historical S&P 500 long-term average. That single missed decision costs approximately $630,000 in tax-deferred wealth accumulation, $630,000, not withdrawn yet, sitting in tax-deferred growth you never claimed. Now, let me be clear about something. This isn't theoretical. The IRS actually provides this tool. Section 408C explicitly allows working spouses to contribute to a non-working spouse's IRA as long as the couple files jointly and has earned income from employment or self-employment. Let's break down the specifics. First, eligibility. You qualify for spousal IRA contributions if three conditions are met. You're married and filing jointly. At least one spouse earned taxable income during the year. You're under the age limit for contributions, typically before age 73 for 2024, though the Secure 2.0 Act made some modifications here. One spouse can have zero income, and the other spouse's earned income can cover contributions for both. Here's the critical part that most people misunderstand. The non-working spouse doesn't need income. The working spouse's income is what matters. So if Sarah earns $120,000 as a software engineer, and her husband Mike is a full-time parent or pursuing education, Sarah can contribute up to $7,000 to her own IRA and $7,000 to Mike's IRA in 2024. That's $14,000 total in a single year. With catch-up contributions available at age 50, that becomes $16,000 annually. Let me give you a concrete case study. Meet Jennifer and David. Jennifer works as a marketing director, earning $95,000 annually. David left his software development career 5 years ago to raise their 3 children. They live in suburban Minnesota with a $280,000 household income, Jennifer's salary plus investment income. For the past 5 years, they contributed to Jennifer's IRA, but completely overlooked that they could fund David's as well. When we analyzed their situation, David had never opened an IRA. They were leaving $7,000 annually completely on the table. Over 5 years, that's $35,000 in contributions they never made. Assuming a 5% annual return, they lost approximately $12,400 in compounding growth. Once they understood the rule, we implemented it immediately. They opened a spousal IRA for David, and now they're contributing $14,000 per year combined. Fast forward 25 years at 5% average returns. And that decision alone will generate approximately $480,000 in tax-deferred wealth versus the $345,000 they would have accumulated otherwise. That's a $135,000 difference from understanding one provision. Now let's address the common misconceptions and objections. First misconception: my spouse doesn't work, so they can't have an IRA. False. As we've discussed, the non-working spouse absolutely can have an IRA. Their lack of earned income is irrelevant as long as the other spouse has qualifying income. Second misconception: we need to split our income 50-50 for this to work. Also false. Let's say one spouse earns $150,000 and the other earns nothing. The earning spouse can still contribute the maximum to both accounts, up to the limit of their earned income. If earned income is $140,000, they can contribute $7,000 to their own IRA and $7,000 to their spouse's IRA because $14,000 is less than $140,000. of earned income. Third misconception, our modified adjusted gross income is too high for IRAs. This ties into Roth IRA income limits versus traditional IRA deductibility. Here's where it gets nuanced. For 2024, if you're married and your MAGI exceeds $230,000 and you're covered by a workplace retirement plan, your traditional IRA contributions may not be fully deductible. However, and this is important, your non-working spouse might still have deductible contributions if they weren't covered by a workplace plan. Additionally, Roth IRA contribution limits are separate and may still be available depending on your situation. Let me walk through another case study, Michael and Patricia. Michael is a surgeon earning $480,000 annually. Patricia stopped working 12 years ago when their second child was born. They're in the 32% federal tax bracket. Michael is covered by his hospital's $401K, so his traditional IRA contributions aren't deductible. However, Patricia isn't covered by any workplace plan, so her spousal IRA contributions could potentially still be deductible, which would save them approximately $240 in taxes annually on a $7,000 contribution. Alternatively, they could consider Roth IRA conversions or backdoor Roth strategies, but that's a more complex discussion. The point is, high income isn't necessarily a disqualifier. Now, let's walk through the actual implementation process step by step. Step 1. Open the account. Choose a financial institution, a brokerage, mutual fund company, or bank. The non-working spouse needs to open an IRA in their own name. This is critical. You cannot contribute to a joint IRA. It must be an individual account. Step 2. Select the account type. You'll choose between traditional IRA, potentially tax-deductible contributions now, taxable withdrawals later, or Roth IRA non-deductible contributions now, tax-free growth and withdrawals later. Consider your current tax bracket versus your expected retirement bracket. Step 3. Determine contribution timing and amount. You can contribute anytime between January 1st and the tax filing deadline, typically April 15th of the following year. For 2024 contributions, you have until April 15th, 2025. The maximum is the lesser of $7,000 or $8,000 if age 50 plus, or the working spouse's earned income minus their own IRA contributions. Step 4. Actually make the contribution. You can fund the account directly or instruct your employer to direct deposit a portion of your income to the IRA. This is where many people drop the ball. They understand the rule but don't execute it. Step 5. File your tax return properly. If contributing to a traditional IRA and claiming the deduction, you'll report this on Form 1040 and Schedule 1. If you have questions about deductibility due to income limits or workplace plans, work with a tax professional. Let me address some common counterarguments and concerns. Counterargument 1. We should maximize our 401k first. True, prioritize matching contributions and any employer benefits, but this isn't either-or. Many couples have room to max both. A 401k allows $23,500 in 2024, separate from spousal IRA contributions, so there's no conflict. Counterargument 2. What if we get divorced? Spousal IRAs belong to the individual account holder. In divorce proceedings, they become part of marital assets subject to division. This is actually why having separate accounts in each spouse's name is important. It creates clear documentation and ownership. Counterargument 3. We might need the money before retirement. IRAs have early withdrawal penalties, but there are exceptions. First-time home purchases, education expenses, medical hardships, and Roth conversions ladder strategies. Additionally, this is precisely why you should fund it. The penalties discourage early withdrawal, protecting your retirement. Let me share one more detailed case study demonstrating long-term impact. Meet Robert and Susan, both age 40, married 15 years. Robert earns $110,000 as a hospital administrator. Susan left her nursing career 10 years ago to care for their children. They're currently contributing $7,000 to Robert's IRA, but nothing to Susan's. They come to us asking if they should start a spousal IRA at age 40 with only 25 years until retirement. We modeled 2 scenarios. Scenario A, continue current approach, only Robert contributes. Over 25 years at 6. 5% average returns, Robert accumulates $415,000 in his IRA, reaching approximately $622,000 by age 65 with continued contributions. Scenario B. Implement spousal IRA immediately. Both contribute $7,000 annually. After 25 years, Robert's account reaches $622,000 and Susan's reaches $415,000 for combined IRA wealth of $1,037,000. The difference, $415,000 in additional retirement security. But here's the often overlooked benefit. If Robert passes away first, Susan has her own IRA accounts in her name, with her own stretch IRA inheritance options and distribution flexibility. Without her own accounts, she'd only have access to Robert's inherited IRAs with different rules. Now let's talk about the lesser-known strategy, Roth spousal contributions. The Roth advantages are significant. Tax-free growth, tax-free withdrawals in retirement, no required minimum distributions at age 73, and inherited Roth accounts provide beneficiaries with tax-free growth periods. For couples expecting higher tax rates in retirement or married to someone with significant future income potential, Roth spousal contributions can be superior. Consider Janet and Kevin. Kevin is 35, a sales professional earning $125,000. Janet is 33, raising their 2 young children. They expect Janet to return to work as an attorney in 5 years, likely earning $180,000 plus. Janet's current tax bracket is 22%, but likely will be 32% or 35% within a decade. Contributing to a Roth now at 22% locks in that favorable rate. In 20 years at retirement, if they are in the 35% bracket, the tax-free growth becomes invaluable. Final consideration, paperwork and documentation. Some couples get tangled in administrative confusion. Here's what you need. 1. Proof of earned income, W-2s, tax returns, or 1099, documenting the working spouse's qualifying income. 2. A separate IRA account opened specifically in the non-working spouse's name and social security number. 3. Documentation that the contribution is a spousal contribution, not a gift. While most brokerages handle this automatically, some couples need explicit communication. 4. Coordination with your tax advisor, especially if you have complex income situations, multiple income sources, or income limits affecting deductibility. In conclusion, the spousal IRA represents one of the most underutilized tax strategies available. The barrier isn't complexity, it's awareness. You're not fighting IRS restrictions, you're fighting your own blind spot. $7,000 annually might not feel enormous, but compounded over 25 or 30 years at realistic market returns, it becomes $500,000.